What is behavioral investing, and how can it improve financial decisions? Defining behavioral investing. Behavioral investing refers to the approach that incorporates psychological factors and emotional biases into investment strategies. This concept acknowledges that investors often make decisions based on cognitive biases, emotions, and social influences, which can lead to suboptimal financial choices. By understanding these influences, investors can make more informed and rational decisions. The role of cognitive biases in investment. Cognitive biases, such as overconfidence, loss aversion, and herd mentality, frequently impact investors' decision-making. For example, overconfidence can lead to excessive risk-taking, while loss aversion might cause an investor to hold onto losing stocks for too long. Recognizing these biases allows investors to correct course and avoid decisions driven solely by emotions. Overcoming emotional decision-making. Behavioral investing emphasizes the importance of managing emotions like fear and greed, which can lead to impulsive actions. For instance, during market downturns, fear might drive investors to sell prematurely, locking in losses. By staying disciplined and focusing on long-term goals, investors can avoid knee-jerk reactions and make decisions based on logic and data rather than emotions. The importance of a systematic approach. A key tenet of behavioral investing is creating and sticking to a systematic investment plan. By having a well-defined strategy that includes clear goals, risk tolerance, and asset allocation, investors can avoid making decisions based on short-term market fluctuations or emotional impulses. This disciplined approach helps in achieving consistent returns over time. Recognizing the influence of social factors. Social and peer influences can also affect investment choices. For example, the herd mentality can cause investors to follow trends or popular opinions, even when it's not in their best interest. Behavioral investing encourages investors to evaluate their decisions independently, focusing on their own financial goals rather than being swayed by external pressures. Long-term perspective over short-term fluctuations. Behavioral investing promotes maintaining a long-term perspective. Investors often become fixated on short-term market movements, leading to reactive strategies that hurt long-term growth. By focusing on a long-term investment horizon and avoiding the temptation to frequently trade, investors can reduce the impact of emotional decision-making and benefit from compounded growth. Using behavioral insights to improve portfolio management. Understanding behavioral tendencies can enhance portfolio management. Investors who recognize their biases can structure portfolios in ways that counteract them. For instance, knowing that loss aversion can lead to avoiding risk altogether, an investor might design a portfolio that includes a balanced mix of assets to manage risk while still achieving growth potential. Education and awareness to mitigate biases. Education is key in behavioral investing. By educating themselves about common psychological biases, investors can become more self-aware and make better decisions. Regularly reassessing their investment strategy, checking for emotional influences, and seeking professional advice can help investors avoid the pitfalls of irrational behavior. The value of professional guidance. Financial advisors can play a critical role in behavioral investing by offering objective perspectives and helping clients stay disciplined. A professional can guide investors through periods of market volatility, ensuring they don't fall prey to impulsive decisions. This external advice helps to reinforce a long-term, rational approach to investing. Improving financial outcomes with behavioral investing. Ultimately, behavioral investing helps to improve financial outcomes by reducing the impact of emotional biases and irrational decision-making. By staying focused on long-term goals, understanding personal biases, and utilizing a structured investment approach, investors are more likely to achieve better financial results and navigate market volatility with confidence.